Hello everyone, this is Professor Kent. Today we are going to uh, re- we're going to do homework for chapter 16. The first question that we are going to take it up is the exercise 1610. Again, this is the back of your chapter in your book, and we're going to work this question together. And the part of the question is prepare the entry to record the issuance of the bond. So this bond, when it was issued on June 1st, 2020. So let's read the question and then do the journal entry. So what we're going to try to do is part A. We're doing an entry at the time you issue a bond. So you issued a convertible bond. So when was it issued? It was issued on June 1st. So that's when we issued on June 1st. The date on the bond is dated on April 1st, 2020. So the bond is dated April 1st, 2020, but we didn't get the bond till June 1st. So what happened is we have something called accrued interest. How much accrued interest is for the 2 months? How did I calculate 2 months? The month of April and the month of May. There's 2 months that is accrued interest. So they said Daisy Inc. issued 6 million of 10-year 9% convertible bond on June 1st, 2020 at 98 and plus the accrued interest. When you're going to work out your cash, you're going to work out your when you work out your cash, what you're going to do is the face value of your bond, which is 6 million, and then we issued it at 98%, and then what we're going to do is we also going to add our accrued interest. How do we calculate our accrued interest? Will be calculated 6 million times the coupon rate. In this case, the coupon rate in the question is given it to us, which is 9%, and it is only for the 2 months. So 2 over 12, which will give you $90,000. So that's the accrued interest. So what they want us to do is they want you to the cash we're receiving is the 98% of the bond and plus the 90,000, and that will give us 5,970,000. That's the value of the cash that we have. So that will be a debit. So in other words, this I think will come out to be 5,880,000. If I add both of them together, that will be the value for your cash. So I'm just going to erase this part of it so that it makes our life a little bit easier when we are saying it. Then we have the credit. We issued a bond. In this case, the bond payable will be your credit. We want to know what will be the value of your bond. The bond was dated April 1st, payable April 1st and October 1st. That means it is semi-annual interest. So we need, when we're calculating, it is a semi-annual interest, and it says it in the question too. The bond without conversion privilege would have been sold at 97% plus the accrued interest. So we're going to calculate the bond payable. You always need to take the face value of the bond, multiply by the 97%. That will give you the present value of your bond, and that is 5,820,000. And then we have a credit, and the question says that it's an accrued interest. Accrued interest is recorded as an interest payable, and I did show you how we calculated the accrued interest. Again, it will be the face value of your bond multiplied by the coupon rate. It is 9% times the 2 over the 12 will give you interest payable. Then what we need is then they said that the rest will be for your contributor surplus conversion right, because we're using the IFRS. So we have contributed surplus conversion right, contributor surplus conversion rights, and that will be our $60,000. So in other words, this is your debit, and then you minus your amount for your bond, you minus for the value for your interest payable, and the leftover will be equity. Like we learned, the cash they paid at 597,000 part of that it belongs to your debt and part of belongs to your equity. Under the bond we have two things. We have under the liability we have two things, bond and interest payable. So those are the two things that we have. This is 90,000, this is 505,820,000. Difference between this and these two numbers is your equity portion, which is your 60,000. So that's what the question is asking you to do for part A. Part A was to record the entry at the time you issue the bond. So now what the second part of the question is asking you to do is B part. Prepare the entry to record the interest expense at October 1st. When we are doing, they're saying to by prorating the number of months. So how do we calculate the prorating the number of months? There's different ways of doing it. Whatever you find it easy, that's the route you will take. So I will do part B here. So in order for, if it's an IFRS, we need two rates. One, we need a coupon rate, which is given to us in the question. Coupon rate is given to us. The other one is yield rate, which is another way. Sometimes the questions will say market rate. It is the same. It is saying the same thing. We need two rates. We're given a coupon rate, but we don't know what the yield rate is or yield to maturity is. That we needed to calculate it. So in order for us to calculate it, we could use an Excel or you could use a finance calculator. I'm going to show you how to use your finance calculator. I can also show you how to do an Excel, but Excel is not going to be used in the class and when you do a test. So it's best to do a finance calculator. So we're going to use the finance calculator to calculate calculate the yield rate. In other words, we're calculating IY using the finance calculator. So let's do that, whatever is given to us, so we could put it in. So first thing is we know that what is the present value of our bond. It is given to us because we sold the bond at we issued the bond at 97%. So that's the money we received. So in this case, that's the present value of the bond, and it will be a positive. Then what we needed is N. They told us in the question we have to prorate the number of months. How do we prorate the number of the months? There, if we think about it, there is a 10 years bond. So 10 years bond, it's a semi-annually. In this case, there's 20 payments in a year. But some months are gone by. If some months are gone by, you have to do how many months are gone by before we got the note? 2 months were gone by. So if we were to do that, if you solve for 2 over 12, and then that will give you your N, which will be 19,667. So that's how we got the 19,667. Then we have a payment. Payment is always calculated using a coupon rate. In this case, our coupon rate, our payment is calculated using a coupon rate. Coupon rate is 9%, and it is one semi-monthly payment. 6 divided by 12, and that gives you 270,000, and that's the payment. Then the face value is what we are going to pay at the end. In this case, it will be 6 million, and that will be a negative. What we are going to compute? We are going to compute our IY, and that will come up to be 47378. So and this is in a percentage. Again, this is my semi-annual rate, and if I needed to calculate this an annual rate, I will multiply by 2 to get an annual rate, and that will be 94756, and that's a percentage. That's the annual rate. So now the coupon rate is 9%, and the market rate is 9.4756. So the question is asking us to prepare the journal entry on October 1st. Now, when you're doing an entry on October 1st, there's two ways of doing the entry. You can do it the table way, or you could do it this way. I'm going to show you both. Sometimes some of you guys might find it the table way easier, but some of you guys might find it not easy. You might find it a calculator will be easy. So now if I were to show you the table way, sometimes you will be able to see the table way better when you're doing the transaction. So when you're doing the transaction, in other words, if first what we going when did we got the sorry we got the note on June 1st, and now what are our first payment? We're doing the first payment will be October, sorry, not October 1st. So our first payment that we are making semi-annual payment, which is October 1st 2020. So now our we recorded the first transaction was recorded on in A was June 1st. From June 1st to October 1st, there's 4 months that has gone by. So what we're going to do is we're going to record the transaction. How do we record the transaction? So in other words, I will do the table way, and I will record the transaction first. I shouldn't have deleted part A. In part A, we have an interest payable. If we're making a payment, what we'll do is we debit the interest payable, and that payable is for 2 months. In this case, it's $90,000. So in other words, how did we calculate it? I'm just going to put it in here. It was 6 million times the 9% times the 2/12. So that's how we got the interest payable. Then what we have is I'm going to show you where we're getting the numbers from. So then we gotta kind of figure out where the numbers are coming from. I'm going to show you where the payments are coming from. This is my credit, this is my credit. When you're doing a cash, we're making a 6 months payment. So even though we're making a 6 months payment, so in this case 6 million was your the face value of your bond. 9% times 6 divided by 12, and that'll give you my 6 months payment. When you're calculating your bond payable, in other words, what we are doing is you have to calculate the interest expense. Interest expense only going to be for the 4 months. If I show you, it will only be for the 4 months. So how are we going to get for the 4 months? The face interest expense is calculated using the face value of the bond, which is 5,820,000. My marker rate that we calculated was is 9.4756. That was the annual rate. Multiply by 4 divided by 12, and that will give me an interest of 183,827. So that's the interest. Now what we had to do is now the other amount that we need for the bond payable, which was your amortization, that will be your 3,827. So the easy way, I'm going to show you the easy way to calculate it. I'm going to change the ink of it. When you're calculating the bond payable, what you're going to do is the difference. In other words, if I were to do a table, let's do a table to make your life a little bit easier. So now we have a date. If you remember that, we're going to do the cash. Our cash payment doesn't change because cash payment stays on the face value of your bond. So in this case, it is face times the 9% times 6 divided by 12. That is 270,000. I'm going to do it for the payment October 1st. I'm just going to work out the 6 months payment, and then from there we can kind of convert the 4 months. Then the next part is your interest expense. So how do we calculate interest expense? And then we have an amortization and carrying amount. Amortization, and we have a carrying amount. And our carrying amount, we started with the present value. In this case, it was 582,000. That's what we started off with. When you're calculating the interest expense, you always have to take the face value of your bond. In this case, 582,000 multiply by your marker rate. Your marker rate is 9.4756 times 6 divided by 12. If that's the case, how are we going to do that? I don't have the number at this point. I'm just going to see if I can come up with a number. I forgot to bring a calculator. I always forget to bring the calculator, but I can use my phone to calculate the number. So just give me a couple minutes to kind of work out the number. So in this case, 5,820 multiplied by the 9%. 8. So the number I have is 275,739.56. So this is my 6 months interest, but we didn't have this for 6 months. We only, how long the bond we had it for 4 months. So this times the four, because we're making a 6 months payment, but some is accrued interest. So accrued interest has already been calculated. So this is the payment we're making it. When are we making it? We're making the payment from June. When we signed the bond, it was the date on the bond was June 1st, so it was only for 4 months. The reason I showed you 6 months was that the payment is for 6 months, but when we are calculating the amortization table, we will only do it for the 4 months for the first one. So we will only do it for 4 months for the first one, and then what we have to do, and the following payment will be it will be for the 6 months. So in this case, 4 divided by sorry, not a month, so it's the 4 month out of the 6. Sorry, it's 4 months out of the 6. So 4 divided by 6 times 4 divided by 6. So then when you're making just to make your life easier, when I'm showing you where the numbers are coming from, if I do 270,000 times the 4 divided by the 6, it will give you 180,000. So that's what you will show on October 1st. And then if I were to do the interest expense, it will be 183827. So you could do it by doing it this way, or you could do it by doing it by the table way. So in this case, difference between those two is your amortization, which is 3827, and what are we going to do is we are going to add it to get your next carrying value, and the next carrying value will be 58,23827. So that's the number, that's the carrying value. And then what we're going to go do is we are going to go to our next payment. I'm just going to finish this table because we need to do a transaction for April 1st 2021. So what we're going to do is we're going to do, this is, in other words, now we are going to do, from now on we're going to do 6 months payment. So if we're doing the first 6 months payment, in this case it will be 270,000. And how did we get the 270,000? And I showed you how to, we got the 270. When you're doing your interest expense is always calculated using the carrying amount, and in this case is 58,23827. Then it will give you it will give you the carrying amount. What you're going to do is carrying amount you multiply by the annual rate. In this case it's 94756, and then if it's a 6 months payment, you're going to do 6 divided by 12. In other words, whatever we were doing it at the top, that's what you're doing it at the bottom. So this is where the numbers are coming from. I think I erased a little bit too much, but that's all right. In this case it is 270,000, and then when we're calculating this payment, it is only, this is 6 months payment, and then we're only recording the 4 months out of that 6 payment. So then if I do it by 6 over 12, it will give me 275,921. I take the difference between those two, that's the amortization I amortize, and that will be 5921, and then I add it because I'm increasing my carrying value, and that will be your 58,29748. So that's the carrying value on April 1st. I'm now going to complete the whole table because the question is only asking us to do an entry on October 1st, and then the C part is asking you to do an entry on April 1st. So let's this was the entry on October 1st. That will be the answer for B. Now what are we going to do is I'm just going to erase this, and then I'm going to do an entry for C, which is your April 1st. Once you do the table, it makes your life easier. So all we have to do is to do a entry for C. When are we doing this entry? On April 1st 2021, and that's when we are doing the entry on April 1st. So April 1st, what happened to April 1st is they said that we're retiring some of the we're converting some of the bond, but we're not converting everything. What we're doing is we're converting only part of the bond. So in this case, we know what part we are converting. They told us in the question on April 1st we are converting 1.5 million of the bond was converted into 30,000 shares. Accrued interest was paid in cash at the time of conversion. Assume that assume the what they're saying, the question is saying assume that we the interest assume that the company follows the IFRS. So we want to do at the time you convert what will be the entry. So first thing we needed to know, what is the value of our bond. This is the value of our bond, but we're not retiring the full bond, we're only retiring partial of the bond. So how do we know which partial are we retiring? So they said that we're retiring 1.5% of the bond. Sometimes they tell you 100%. In this case, they told us that we are retiring only 25% of the bond. This is how we got the 25%. Sorry, we're converting 25%, converting 25% of the bond. So first we have to need a carrying value. The carrying value, we already know what was the carrying value on April 1st. April 1st was that, but we're not converting the whole thing, we are only converting 25%. If I convert 25% of that, that will give me 1,457,437. So if I take the carrying value, multiply by 25%, that's the bond being converted. So debit will be bond payable. In this case, the bond payable amount will be 1,457,437. So that's the value of the bond. Then of course, if you're converting the bond, the other part will be debit will be contributor surplus conversion right. Surplus conversion rights. So when we are doing that, when we did the entry, our first entry was for the was for $60,000. That's the value, but we are only converting. So we have to go to part A. In part A, our conversion rights were 60,000 multiplied by the 25%. That will give you how much of the rights are being converted, and the credit will be my common shares. So how do we calculate the value of your common shares? Again, we take the value of your bond payable, and what we do is we add contributor surplus conversion rights. Surplus conversion rights. In this case, we add these two numbers together, and that will be 472,437. So that's when at the time you convert. So that's the answer to part C. Now they're saying part D, we have to show them how did it is to prove it to them this number is correct. So they're saying to use the finance calculator function to see if this repeat part C by using the financial calculator. So now what we are going to do is we wanted to know what happened to your, if you use a calculator, do we get the same number? In other words, we will get the same number. How do we do it? I'm going to show you how to do that. The face value of your bond did not change. So what we're going to do, the face value of the bond did not change. Your payment is going to be the same, and I'm not going to show this again because we showed it before. And then we have the IY, which we calculated in the when we calculated it here, which was 4.7378. I'm going to erase it again. So the value was that which we calculated in part B, and it's a semi-annual rate that you are going to put it into your calculator, and your N is 18. So in other words, N is 18. So now if when we did the entry on October 1st, what we did is 19.667. So now what happens is that some months are gone by, so now it's 18 months. So another way of doing it, how did I get the 18 months? If you were to do that, The date, if you were to look at it, the date of the bond was April 1st. I'm trying to think, where am I here? April 1st, April 1st, I saw the date, April 1st, 2020. And then what happens is now we are on April 1st, 2021. That's when we're retiring the bond. So that's when we're retiring the bond. So if you go back and then you count the, if you count the month, sometimes makes it a little bit easier to count it thing. If you're finding a little bit difficult to calculate it, what you're going to do is the 1 year is gone by. If 1 year is gone by from April 1st to the 21st, 1 year is gone by. In 1 year, there's two payments. In this case, two payments are gone by. It was for 10 years. There's one. You could do it either way. You'll get the same answer. So in this case, the 1 year is gone by. So the life of the bond was 10 years. 1 year is gone by. You're left with 9. 9 times 2 is 18. That's one way of calculating it, or you could do it any other way you find it easy. So in this case, your n will be your 18. What we're looking for is we're looking for the present value of your bond. What you're going to do is compute your present value. If you compute your present value, you should get an answer 5,829,743, and this is the using the calculator, you'll get the same amount that we got when we did our table. And then what we're doing is we're converting 25% of the bond. If you're converting 25% of the bond, then what you do is multiply by the 25%. You will get a similar answer. Maybe you're out by 1 or 2 cents. That's all. You're going to be out by 1 or 2 cents. So now let's see what the next part of the question is asking us to do is so they're saying part D, use the finance calculator to calculate the bond. So we did that. So what we did the finance calculator to calculate the bond. And then the next is that assume that Daisy follows ASPE, discuss how the issuance of the convertible debt is recorded, and prepare the entry to record the issuance of the bond in June 1st, 2021. So what the question is asking us to do is, how, if the company was following an ASPE, what will be our first entry that we did in part A? Would that change? Yes, of course it would change, because when we issue a bond, ASPE, unless you're told, ASPE makes the equity portion to be 0. So that's what they want to do. So let's do the part E. Then we could do part E. If the company was following an ASPE, what they prefer is when they issue a bond, they make the equity portion of the bond to be 0. So whatever the present value of the bond is going to be the value of your bond. So how would you record the entry on June 1st if the company was following a ASPE standard? So June 1st, 2020, we issued the bond at 98 plus the accrued interest. So again, debit will be a cash. How much that will be? You have your face value of your bond is 6 million. And then what we did is we issued it at 98% plus your accrued interest. Accrued interest is 90,000. Again, how did I get the 90,000? You have your 6 million. You multiply by the coupon rate times the 2 divided by the 12, and that's how we got the 90,000. So in this case, the cash we received was 597,000, and then what we have is we have a bond payable. The value of your bond payable will be the 98%. So in this case, it will be 98% plus the interest payable. So in this case, we have an interest payable. In this case, the interest payable was 90,000, and that will be the 5880123, which is multiplied by the 98%. So that was part E. If the company is an ASPE company, they make the equity portion to be zero. That's what they prefer, the equity portion to be zero. So then they're saying that number F, what do you believe was likely fair value of the common shares as of um, April 1st, 2021? At the time we converted it, they're saying, can you say what the value of your common shares is going to be? Yes, but it's not an accurate number. Again, how you're going to do it? What is the value of your the book value of the bond that was converted? In this case, the value of your bond was 414,72436, and what we did is we converted into 30,000 common shares, and this is 30,000 common share. Approximately whatever this number will be, that will be the value of your I'm trying to look for my phone to see if I can calculate the value of your common shares. So in this case, it's going to take me a minute to calculate it. 1472436 divided by your 30,000, and that will give me the value of my common share at the time we're converting. It is 49.08. So that's the value per share. So fair value of the common share as of that is $49 per share. So that's what it's going to be. So now the next question that I wanted to do was the 1611, and that's the other question that I wanted to take it. I wanted to do 3 questions today. So that will be my next question that I have to do is 1611. So let's do the question and see what the question is asking us to do so that we could do this question. So now okay, so this is saying assume the book value method is used, what entry would be made? So we're going to make an entry at the time you issue the bond, at the time you convert it, and at the time you retire it. Those are the three things can happen. So in this case, the question is saying we're doing a conversion. So let's do the A part. Virgo Limited had 2.4 million of the bond payable outstanding, and unamortized premium on this amount was 44,500. Each 1,000 bond can be converted into preferred shares. So bond, when you have a debt, any debt can be converted into common shares, or it can be converted into preferred shares. So in this case, it is being converted into preferred shares. So let's do an entry at the time you issue it. What we did is we had a $5 million with unamortized. So the face value of your bond that is being converted, face value of your bond is 2.4 million. So that's what the face value of the bond is. And then what we have is, in this case, they told us what is it? Unamortized premium. So you could have a premium or you could have a discount. If it's an unamortized and it's in a premium, what you're going to do is you're going to add it to the face value of your bond. So in other words, if it's an unamortized, it's a premium, you add it. I'm going to change the ink to show you. If the question, if the question says that it's an unamortized discount, and if it's unamortized and it's a discount, what you're going to do is you'll be minusing it. Why do we to get the carrying value of your bond. So to get the carrying value of your bond. So in this case, what I'm going to do is I will have a 005444, and that's the value of your bond. So in this case, we have a bond payable that will, if you're converting it, you will have to debit the bond payable of $244,500. So that's my debit. If I'm converting it, I have to get rid of our contributor surplus, conversion right, contributed surplus, and conversion rights, and that is your we're converting the whole thing. In this case, it's 22,200, and what we're doing is we're converting it into preferred shares. the questions that we did before, it was converting it into common share. In this case, we're converting into preferred shares. Again, the value of your preferred share is the value of your bond payable plus your contributor surplus conversion right. So that's what it stands for. In this case, I add these two numbers together, and that will be the value of your preferred share. So in this case, that's the value of your preferred share. Now in this case, the company is following an IFRS standard, so they're saying that now they saying assume that Virgo Limited offer 9,000 to induce the bond, induce early conversion. What it will be the journal entry. If it's an IFRS, we're paying extra. Whatever extra we pay, it comes out of as a loss on a redemption of a bond. So let's do the entry. What they did is in the B, they said that they paid extra. So let's do the entry for the B. So how much extra they paid? They paid 9,000 extra. If they paid 9,000 extra, that will be a cash, and debit will be loss on a redemption of a bond. A redemption of bond, and that will be your $9,000, and the rest entry will be exactly the same. So debit will be your bond payable, and that we calculated in the part A, which is 244,500, and then we have a debit of contributed surplus conversion rights, surplus conversion rights, and that is 22,200. And then what we have here is your credit will be your preferred share, and the preferred shares are 2466700. Again, the value of your bond and the value of your contributors surplus conversion right, if you add them together, that will give you preferred shares. Now what is part saying here from the part C? From the perspective of the bondholder, what is likely motivate for the conversion of the bond into preferred shares? If I think of it, I had the bond payable. Now what I am doing is we're converting into preferred shares. Who are preferred shares? Preferred shares are the preferred people. First, we're gonna, instead of getting the interest from the company, what you're gonna get is you're gonna get a dividend from the company. Anytime the company issue a dividend, preferred shares gets the first bit on the shares before it goes into the common shares. So instead of getting an interest, they're going to get a dividend, and if they're getting a dividend from the perspective of the bondholder, they're going to get the first if anytime the bond dividends are issued, they're going to get the first bit on the bonds. So that's what happens. So that's why that's what happens. So now this is the next question. It seems like it's a big question. 16.3, that's our next question, which is the last question that I promised that I will do the recording of it. In this case, it is 16.3. 16.3 seems like a big question, but don't make it like it's a big question. What you have to do is just do piece by piece. When we did the 16.10, the company was following a IFRS standard. When we're doing the question number 13, the company is following an ASPE standard. So that's what they're doing. The company is following an ASPE standard. So you could be asked to do IFRS or you could be asked to do ASPE. So it depends on what you're asked to do. They're saying on January 1st, 2020, when the fair value of its common share was $80 per share, Hammond Corporation issued 10 million of 8% convertible debenture. So what we did is we issued it. How much did we get? So now the part here is that the debenture were issued for 10.8 million. So when the question is asking to prepare the journal entry to record the original issuance of the convertible debenture, so first what we know is debit is the cash. How much money are we getting? 10,800,000. So that's the money we're gonna get. They're saying the bonds payment present value at the time of the issuance is 8.5. So what is the value of our bond? Our bond payable The value of our bond is 8500. That's the value of their bond, present value of the bond. And they're saying the amount paid is attributed, the difference between the present value and the amount paid attributed to the conversion portion. So this is the amount they paid to us, and then this is the bond value. Difference between the both is our contributed surplus conversion right. So contributed surplus conversion rights, and that is my credit, and that is my credit, and that is my debit. So in this case, difference between the both will be the value of our contributor surplus conversion rights. So now in this case, they want you to, that's the entry you will do it at the when you're doing a part. So now if you were to look at it, what is the present value of our bond? Our present value of our bond was 8.5 million. What is the face value of our bond? The face value of the bond was 10 million. So we issued the 10 million bond for 8.5. So the face value of the bond is 10 million. So that's what is given to us. We issued a 10 million bond, and the present value of your bond is 8.5. So what happens to this bond? What type of bond is this? It's discounted bond. How much is the discount? So difference between the both is my discount. In this case is 1.5 million. We needed to amortize it. We needed to amortize over the 20 years. So saying using the book value method, prepare the entry to record the exercise of the conversion option. So we wanted to know how much. There's some information is there that we don't need at this point, but we might need it later on. So what did we do? We converted everything, or we converted, how much did we convert? So it's saying on January 1st 2020. So our first entry was done on January 1st 2020. The second entry we had to do is January 1st 2022. How many years are gone by? 2 years are gone by. Now what are we trying to do? We're trying to do a journal entry at the time we convert. What we are converting, only 30% of the bond is being converted. So in order to us to do 30%, first thing we needed to do is find out the carrying value of the bond. So in order for us to do the carrying value of the bond, how do we want to know how much of the bond is amortized. In this case, if I were to think of it, year 2020 is gone by, year 2021 is gone by. So now what we are doing is, at 2 years has gone by, how much of the discount we amortize. So in other words, how much of the discount is amortized. I'm just going to change the ink. If this was my amortization, I amortize over the life. In this case, the life is 20 years. If I amortize it, how much I amortize? 75,000 is being amortized every year. So 75,000 for the first year, 75,000 for the second year. That is being amortized. So the carrying value, if I started off with 85,000, how much is being amortized? 75 and 75 each year. So I can find out the carrying value of the bond. So the carrying value of the bond will be, if I add them together, it will be 86500. So 86550, that will be the value of your bond. So we're not retiring the 100%, we're only retiring the 30% of the bond. So if I'm returning 30% of the bond, that's what I will amortize in this case. So the first thing you're going to do is you're going to multiply it by the 30%. So when you do 30% of that, so that will give me bond payable. Debit will be your bond payable. In this case, the carrying value of your bond is 865000 to multiply by the 30%, and that will give me the carrying value of your bond. So that will be the debit of your bond payable. And debit will be, since we are converting it, it will be called contributed surplus conversion rights. So you're going to go back to your first part. How much was the conversion right? It was 2.3 million, and I multiply by the 3% because we're only converting 30%, that will be 690,000, and credit will be your common shares. And the common share, again, you add your bond payable to the contributor surplus, that will be the value of your common shares. If I add them together, it will be 3285000. Now there's a different way of calculating the carrying value, so you could do it any way you want. One, if you, this is one way of doing is, if the other way to do is, my discount was 1.5 million that I needed to amortize, so I could amortize. I already amortized $150,000 from it, and then how much is unamortized discount. So if this is the discount to be amortized, which what we, when we started it, and we amortized already, so how much is your unamortized discount? In this case it's 1.3500. So in other words, if you could do it, this times your 30% that you are converting. So the unamortized discount on the bond that you are converting is 405. In this case it's an unamortized and it's a discount. If that's the case, that is a minus from the face value of the bond. The face value of the bond is $3 million. So when we think of it, how did I get the 3 million? Because the total value of your bond was 10 million, we're converting 30% of it. That's how I got the face value of your bond. And if it's an unamortized discount, it's a minus, and that will give you the value of your bond payable. So you could do it any way you want, whatever you find it easy to calculate it, that's the way you do it. So I think the book does it this way, and I normally show it this way. So whatever you find it easy, that's the route you will take. So now my next question is C. The question is C, saying that how many shares were issued as a result of conversion. So we want to know how many shares was issued at the time you converted it. So we, in order for us to do that, we do have a stock split, and then we needed to know how many shares was issued. So in this case we needed to go back to the question to see how many shares were issued. So now let's I'm just going to erase some of the things here so I could see where we are going. I'm going to erase this part too to make my life easier to see where my question is going. So then there is a less on the screen. So they're saying how much bond we have. We had 10 million bonds. So that's the first thing. Where did I get it? The 10 million. We have the 10 million bond. So they're saying the conversion option allow the bondholder of each 1,000 bond to convert into 5 common shares. So each 1,000 bond, this is the 1,000 bond. How many bonds we have? We had 10,000 bonds. So how did 10,000 bonds, each bond can be converted into 5 shares. So how many shares? In this case it's a 50,000 shares. But we had a stock split happen. If it's a stock split happens, what is it? Is stock split is 2 for 1. In this case, how many shares was converted after the stocks? How many shares we had after the stock split? It was 100,000. We're not converting everything. We're converting only 30,000, 30%, and that will give me how many share was converted at the time we converted. It was 30,000. So the answer to C was is going to be 30,000. So if I go to my D, in other words, it's a theory question. From the perspective of Hamid Corporation, what are the advantages and disadvantages of conversion into bond? So now if it's a company, Hamid Corporation, if this is a company, they will have an advantage, they will have a disadvantage. So they will have a both disadvantage and advantage. If you think of from a company point of view, they have a it's in a, from there they have no obligation to pay a dividend. So no obligation to pay a dividend. What do we mean by that? If you have bond, what we have to do is we have to make interest payments. Soon as the bond is converted into common shares, we have no obligation to pay them the bond. Here we have an obligation to pay them the interest. When you have a common shares, we don't have an obligation to pay them the dividend. So what they have no obligation to pay the dividend. So another, from the company view, of from the Hammett's Corporation point of view, they had no obligation. If bond dividends are declared, that's when we paid, but there's no obligation till we declare it. So that's the first advantage they will have. There's no obligation to pay the principal, no obligation to pay the principal of the bond. So no obligation to pay the principal amount. Now, of course, the disadvantage will be our net income will increase. Our income will increase. So not net income, our income will increase. Why our income will increase? Because if I will explain it to you why. The income, this income will increase. If there's income is increased, we pay more to the CRA in our taxes. So our income will increase. If our income increase, our tax will increase. So if the company had a bond, they can write bond, they have to pay interest. Interest expense is a write-off when we're calculating our income. If we don't have a bond, then what happens is we have a dividend. Dividends are declared after we pay the taxes. So that's the thing, is that this is a disadvantage from the company point of view, that they will not be able to take the benefit of it. The other positive effect is your debt to equity ratio will change. So your debt over equity ratio will change. It will be a positive debt to equity ratio. So let's look at the point view from the the E part. So what happens in E part? So let's look at the E, saying what the E is telling us to do. So E is asking us to do, what if the company instead of Hammett Company decided to retire the bond early on January 1st, 2020, they pay out cash to the shareholder on that day. The fair value of the bond without conversion was 870. So now we're converting the bond, but in other words, we are using an ASPE. So first what we needed to do is, if you go back to my previous recording, the chapter example recording, we needed to find out the gain and loss on the bond first before we could do anything in this case. So let's do first what we could do is, in this case we paid cash, so that number is given to us. The cash is that we paid was they retired the bond. So in this case the cash we paid is 330600. So now we needed to calculate the carrying value of the bond. The carrying value of the bond is still going to be the same. We're still converting the 30%, but we're retiring the 30%. So debit will be your bond payable. I showed you how we calculate the bond payable. Is the carrying value of the bond multiplied by the 30%, because that's what they are retiring. The 30% is being retired. 2595000. Contributor surplus, again that did not change. Contributor surplus, that did not change. That is contributor surplus conversion rights, and that is 6900. That is same. And then what we doing is, now we have to the difference between what we paid will be split, but we needed to first calculate do we have a gain or a loss on a redemption. We needed to find out, do we have a gain or we have a loss on a redemption. So how do we do it? We have to find out the carrying value of the bond sitting in our books, and then the fair value of the bond that is out there. So we are retiring 3000 of the bond times the 870. That's the fair value of our bond. In this case, whatever is the both, I have to do it on my phone again, and I apologize for not getting a calculator hand before recording it, but it will be okay. So in this case, 2610000. So fair value of our bond is more than the carrying value. If it's more, we have a loss. How much is the loss? The difference between those two will give me the loss. In this case, the loss will be $15,000. So in this case, we will have a loss on a redemption of a bond. Redemption of bond, and that is 15,000, and the leftover will go to my retained earning. Again, retained earning at this point will be a plug-in number, and retained earning will be if I add them and then minus it from this number, and that will be your retained earning. In this case, it will be $6,000. So that will be your part E. That is part E for your 13. So I promised to do the recording for the 3 questions. I kept my promise. If you have any question, talk to me in the class or send me a message here. I will reply to the message. Thank you so much for listening to me. I will see you later.